This is a demonstration of exercise 2222B, change from fair value to equity. On January 1st, 2020, Beyonce purchased 25,000 shares, a 10% interest in Elton John Corporation for $1,400,000. At the time, the book value and the fair value of John's net assets were $13 million. On July 1st, 2021, Beyonce paid $3,040,000 for 50,000 additional shares of John's common stock, which represented a 20% investment in John. As a result of this transaction, Beyonce owns 30% of John and can exercise significant influence over John's operating and financial policies. Then the problem gives us that John reported the following amounts of net income and declared and paid the following dividends. And the problem gives us the net income that John reported for 2020, and they issued no dividends. Then they give us the income for the 6 months that ended June 30th, 2021 that John reported, and they declared no dividends. Then the problem gives us the second 6 months for 2021, and they did declare a dividend. So what happens when a company has a significant ownership change? Many times they will close their books. And that's what happened here. If you notice, Beyonce bought or made the additional investment on July the 1st, 2021. Before this time, Beyonce only had a 10% interest and would have been using the fair value method. However, after the additional 20% of the stock was purchased, Beyonce then owned 30% and would have to begin to use the equity method. So the instructions state to determine the ending balance that Beyonce Company should report as its investment in John Corporation at the end of 2021. So if you remember from the text, this is one of the situations that's in the appendix that normally we would use the retrospective treatment for changes in reporting entity, but this is one of the exceptions. Changing from fair value to equity, the FASB has stated that we should use the method prospectively. So that means that at the date that Beyonce acquired the additional stock and had a significant influence over John, they would begin to use the equity method. So we can use this information and calculate what the ending investment would be at the end of 2021. First of all, we start out with the initial investment. They paid $1,400,000 for the original 10% interest. Then, as the problem stated, on July the 1st, they paid an additional $3,040,000 for 50,000 additional shares. So it was at that point on July 1st that Beyonce should begin to use the equity method. So that means they're not going to go back and use the equity method for these prior periods when they only own 10%. That's a change, a fairly recent change. They used to use retrospective treatment for this, but now we will be using only prospective treatment, which means that at the end of 2021, when John reported their net income of $815,000, Beyonce would record or report as investment income, a credit to investment income, and a debit to the investment account, their percentage ownership in the investee, John's net income. So John's net income was $815,000, Beyonce owned 30%. So they would record an additional $244,500 as an increase to the investment account, and that would have been credited to investment income. Also, they did receive dividends. At the end of 2021, they now own 75,000 shares. They own 25,000 to start and bought an additional 50,000. The dividend per share was $1.55. So when we multiply 75,000 shares times $1.55, we get $116,250. Now remember, when you use the equity method, the dividends are not credited to dividend income. They are subtracted from the investment account. So that $116,250 would be subtracted from the investment account. And of course, that's a credit, and the debit would have been to cash. So we can see that at the end of 2021, the investment account, Beyonce's investment in Elton John Corporation, should be $4,568,250. And that is the conclusion of the demonstration for exercise 2222B.